Welcome to the Whispers of Wealth. Tonight, we drift into a topic that sounds like it should come with either a political science degree or a stiff drink. But you won't need either. Just get comfortable. We're about to explore what really happens to money during a war. At first glance, war looks like pure destruction. Cities burn, economies collapse, banks shutter. It feels obvious. Wealth must vanish too, right? But here's the strange part. Wealth doesn't disappear in war. It shifts, it hides, it finds new owners, and sometimes it quietly multiplies while everyone else is distracted by the smoke. You start to notice something peculiar about human history. Every time there's a conflict, someone is losing everything, and someone else is gaining quietly in the background. The rich don't always get poorer during wars. Often, they just change strategy. Think about ancient Rome. When the empire faced barbarian invasions, aristocrats didn't rush to the front lines. They moved their assets. Gold was buried. Land was swapped under the table. Valuable paintings and scrolls were quietly loaded onto ships bound for safer shores. Wealth didn't vanish. It went underground. Literally. Fast forward to the modern world, and the pattern repeats. Wars destroy property, yes, but not the concept of ownership, and certainly not the systems that protect capital for those who know how to move it. If you're clever, you don't hold wealth in fragile things like paper money or real estate sitting in a war zone. You hold it in gold, offshore accounts, or government contracts that pay out whether your side wins or loses. It's not just an accident of history, it's a feature of how wealth works. Money isn't about piles of coins, it's about control over resources. And control tends to survive the cannon fire, even if the cities don't. Take World War II. Entire nations were leveled. Families lost everything. But in the shadows, new fortunes were being made. Companies retooled factories to make weapons instead of washing machines. Neutral countries offered banking services to both sides. No questions asked. Some wealthy families diversified early, moving assets abroad before the borders closed. They stayed rich while the rest of the world rebuilt from ashes. It's not always sinister. Sometimes it's just logistics. Imagine you're a textile merchant in the 1800s. War breaks out, cotton shipments stop, prices spike. If you happen to have a warehouse full of cloth, congratulations, you're now sitting on a fortune. You didn't start the war, but the war just made you richer. There's even a soft paradox in all of this. War creates scarcity, and scarcity creates profit, especially for those who plan ahead. Oil, metals, food supplies, shipping routes, they all become chess pieces on a new board. And the people who know how to play that board don't always wear uniforms. Sometimes they just wear good suits and avoid eye contact. And then there's the government. In wartime, governments spend like insomniacs with online shopping addictions. They borrow, they print money, they sell bonds, they redistribute resources. But here's the catch. Those borrowed billions don't vanish after the war. They become part of the economy. Someone holds the debt. Someone earns the interest. In a strange, quiet way, war becomes a wealth transfer machine. Sometimes from taxpayers to investors. Sometimes from the conquered to the conquerors. But always from one pocket to another. Of course, not everyone wins. Most people lose. Workers see their wages frozen or inflated away. Ordinary families find their savings evaporating. Businesses collapse under rationing. But behind the scenes, wealth doesn't disappear. It reorganizes. Historians have a phrase for this: creative destruction. It's the idea that in order for something new to grow, something old has to be broken first. War is the ultimate version of that. Empires crumble. Economies shift. And while the world mourns what's lost, the blueprints for the next system are already being drafted, often by the same people who owned the last one. Even the very concept of money changes during war. Soldiers might get paid in ration coupons instead of cash. Black markets spring up, trading cigarettes for bread, gold for safety, favors for fuel. Wealth becomes whatever helps you survive. And for some, that's where the real profits begin. Not in winning the war, but in controlling the chaos around it. You start to sense the larger pattern. Wealth during war is like water. It flows around obstacles. It fills new spaces. It might leave old places dry, but it doesn't vanish. It pools somewhere else. The medieval Italian bankers knew this. So did the Dutch merchants during the 17th century wars. So did the industrialists in the 20th century. And if history is any guide, someone is already positioning themselves for the next round of global shifts, moving assets, securing contracts, watching for opportunities in the fog of conflict. And that's where our story begins. Because tonight isn't about who fires the first shot. It's about who counts the money afterward. As you settle in, you start to realize war doesn't destroy wealth. It just moves it. And in the chapters ahead, we're going to follow where it goes. You start to notice something odd when you look at history. Not just the wars themselves, but how they're funded. Because wars aren't free. Someone has to pay for the swords, the ships, the uniforms, the night vision goggles, the drones, the overpriced pencils in military procurement offices. All of it costs money. And here's the gentle, uncomfortable truth, that someone is usually you. Not directly, of course. You're not personally writing checks for battleships. But the money still comes from ordinary people. It just takes a few creative steps to get there. Let's start with the basics. When a country goes to war, it suddenly needs a lot more cash than usual. But governments don't earn money the way businesses do. They don't sell products or services, unless you count postage stamps, and those won't buy many tanks, so they turn to three options: taxes, debt, and printing more money. Sometimes all three at once. First, taxes. This is the oldest and most direct method. Kings and emperors have been squeezing their citizens for war funds since ancient times. Medieval monarchs taxed salt, grain, property, and even windows. Yes, there was literally a window tax in 17th century England, which led to the architectural trend of bricking up windows. It wasn't just bad interior design, it was tax avoidance. But here's the thing about taxes: they're unpopular. Raising them during wartime risks protests, rebellions, or at the very least, some strongly worded letters. So governments often look for other methods. That brings us to debt. Instead of taxing everyone up front, governments borrow. They issue war bonds, essentially IOUs promising to pay back investors later with interest. During World War I and II, posters urged citizens to buy bonds as a patriotic duty. The messaging was emotional. Lend your savings to your country. It sounds noble until you remember that governments pay back those bonds using future taxes. So really, you're lending money to the government now, only to have them tax you later to repay you. It's like taking money from one pocket and promising to return it with interest from your other pocket. Still, bonds work. In fact, they're part of why modern financial systems exist at all. The birth of national debt as we know it came from wars, especially in 18th century Britain, where the government financed endless military campaigns by selling bonds to wealthy citizens and banks. It turned war into an investment opportunity. Buy a bond today, watch the colonies expand tomorrow. Then there's the third method, printing more money. This one is trickier because it's easy to abuse. When governments run out of cash and credit, they can simply create more currency. In small doses, this keeps things moving. In large doses, it causes inflation, the quiet thief that erodes the value of everyone's savings. Germany after World War I is the classic example. To pay reparations, the Weimar government printed so much money that a loaf of bread went from costing a few marks to costing a wheelbarrow full. People burned banknotes for warmth because fire was cheaper than fuel. But hyperinflation isn't just a historical footnote. It's a reminder that when governments print money to pay for wars, they're not creating wealth. They're shifting it from savers to debtors, from workers to asset holders, and often from the poor to the rich. There's a quiet elegance to this system, a dark elegance, but elegance nonetheless. Because war finance isn't about paying bills, it's about moving the burden around. During the Napoleonic Wars, Britain introduced the income tax for the first time. It was supposed to be temporary. It wasn't. Once governments find a new revenue stream, they tend to keep it, even after the cannons fall silent. In the US, the Civil War led to the first federal income tax, passed in 1861 to fund Union troops. Again, temporary. Again, not really. War finance also creates entire industries. Banks get involved. Bond markets grow. Insurance companies invent new products to hedge against military risk. Accountants suddenly become national assets. There's even a financial term for this: the military-industrial complex. It's not just about making weapons, it's about managing the money that fuels the machinery. And sometimes that machinery outlasts the war. After World War II, the US kept its wartime tax rates high for decades, funneling the funds into new forms of defense spending, foreign aid, and eventually, the Cold War. Once the economy learns to run on military budgets, scaling back becomes complicated. Meanwhile, certain industries quietly thrive. Steel manufacturers, shipbuilders, tech companies that pivot from consumer gadgets to surveillance equipment. Even clothing brands get contracts for military uniforms. The money flows, just not always where you'd expect. There's also a quiet social cost. When governments divert resources to war, they often cut spending elsewhere. Infrastructure decays, healthcare gets postponed, schools go underfunded, but the tanks roll on schedule. And while the headlines focus on heroism and sacrifice, there's always someone balancing the budget behind the scenes. Some historian once said, "Amateurs study battles, professionals study logistics." But in the modern world, logistics often means accounting. You start to notice a pattern. Wars change not just the political map, but the economic one. Debt piles up. Inflation creeps in. Taxes rise. And new financial systems emerge to manage it all. The war ends, but the structures that paid for it remain. And so does the question, who actually profits? In theory, everyone's contributing to the war effort. In practice, some are just collecting the interest. That's the quiet truth behind every conflict. The cannons may be loud, but the accounting is louder, if you know where to listen. In the next chapter, we'll follow the people who listened early, the ones who figured out how to sell to both sides and walked away richer no matter who won. Because in war, neutrality is sometimes the most profitable position of all. You start to realize something strange about war. It divides nations, yes. It fuels speeches and patriotism and newspapers filled with maps. But behind the scenes, there's always a quieter conversation happening. A conversation about supply chains, contracts, and who's selling what to whom. Because war isn't just about soldiers, it's about stuff. Weapons, boots, food, fuel, fabric, raw materials. And someone has to provide all of it. That someone is often a merchant, and sometimes, very quietly, that merchant sells to both sides. This isn't new. It's not a glitch in the system. It's the system itself. Take the Napoleonic Wars, for example. Britain and France were locked in battle for over a decade, but British merchants still smuggled goods into French ports, often through neutral countries like Spain or Portugal. Why? Because commerce finds a way. Cotton doesn't ask for passports. In the American Civil War, northern textile factories still depended on southern cotton long after the first shots at Fort Sumter. Union blockades tried to stop the flow, but merchants are nothing if not inventive. Smugglers used fast ships, backdoor deals, and international intermediaries to keep the supply lines moving, and profits rising. This pattern repeats itself in almost every conflict. During World War I, Swedish steel companies sold materials to both the Allies and the Central Powers. Sweden was officially neutral, but neutrality doesn't stop exports. Iron ore mined in the snowy north ended up in German warships and British railways alike. For Sweden, it wasn't about choosing sides, it was about choosing invoices. Even in World War II, similar stories unfolded. Swiss banks quietly held gold for Nazi Germany, while also providing financial services to the Allies. Swiss companies manufactured precision tools used in both Allied and Axis industries. The country maintained its neutrality and its trade balance. It's not always sinister. Sometimes it's just survival. Small nations caught between empires often sell to both sides because that's how they stay afloat. And because wartime demand is, let's say, robust, prices go up. Supply chains get desperate. The profit margins get wider. There's even a term for this: the arms dealer's dilemma. If you sell to one side, you're a patriot. If you sell to both, you're a capitalist. Consider Basil Zaharoff, sometimes called the Merchant of Death. He sold weapons across Europe in the early 20th century, often to rival nations. He wasn't particularly loyal to anyone, except to profit margins. He'd sell submarines to Greece, then turn around and offer the same to Turkey. He once sold obsolete weapons as cutting-edge tech and still got invited to dinner by kings. Zaharoff didn't cause wars, but he certainly didn't mind when they happened. This isn't just about weapons, though. Food supplies, for example, are a huge business during wartime. Merchants and traders ship grain, meat, and sugar wherever they can get the highest price. During Napoleon's campaigns, British merchants sold saltfish to feed French troops, even while their own navy fought French ships at sea. You start to understand why economic historians love the phrase, "war is good for business." Not for everyone, of course. Farmers suffer, workers get drafted, families lose everything. But for certain industries, war is a gold rush in camouflage. The defense industry today is built on this foundation. Companies don't just sell to their home governments, they sell globally. Fighter jets, surveillance software, missile systems. The line between national defense and international commerce blurs quickly when there's profit involved. During the Cold War, for example, American companies quietly sold technology to the Soviet Union, often through third parties or shell corporations. Computers, industrial equipment, sometimes even machine tools used in weapons production. The money moved faster than the politics did. And then there's the grey market, the places where official policy looks the other way while trade continues. During the Iran-Iraq War in the 1980s, companies from various countries, including Western nations, supplied weapons to both sides, sometimes under the table, sometimes in plain sight, with carefully worded contracts. Both nations fought brutally, but the arms manufacturers kept shipping. Even humanitarian supplies become part of this system. During World War II, the Red Cross sent aid packages to prisoners of war, packages that included food, chocolate, and cigarettes. Black markets formed instantly. Cigarettes became currency. Some guards took bribes in chocolate bars. Economies don't stop for ethics. And here's where it gets interesting. The people who supply both sides often survive the war better than those who pick a team. When the dust settles, new governments need the same things old governments did: infrastructure, supplies, reconstruction contracts. The merchants who maintained relationships on both sides are perfectly positioned to step in. After all, they already know the system. They probably wrote part of it. This isn't to say war profiteering is universally admired. It isn't. There's a moral cost, and sometimes a legal one. But from a purely financial perspective, neutrality often pays better than loyalty. And the people who master that game usually aren't in the history books. They're in the ledgers. You start to realize that war isn't just about who wins or loses on the battlefield. It's about who controls the supply chain while the battle is happening. And as long as wars need resources, and they always do, someone will be there to sell them, preferably at a premium. In the next chapter, we'll follow the rise of a system designed to manage exactly this kind of economic chaos, the banking sector. Because when you need to fund a war, or profit from one, you need more than weapons. You need a place to keep the money. You start to notice something about the history of money. Most of it happens quietly, in ledgers, in contracts, in back rooms with expensive rugs. But every so often, finance crashes headfirst into history. And when that happens, it's usually because of a war. Because wars don't just change maps, they change money. At first, banking and battle don't seem related. One involves dusty ledgers and cautious men in waistcoats. The other involves cannons. But look closer, and you'll see that the two have always held hands, sometimes under the table. It starts in Renaissance Italy, where merchant families like the Medici invented modern banking. They weren't just keeping coins safe for their clients, they were financing wars. Kings and popes needed armies, and armies needed payroll. The Medici provided both the credit and the currency exchange services. They didn't wear armor, but they controlled the purse strings of Europe. This pattern repeated itself across the centuries. Take the Rothschild family. By the 19th century, they weren't just bankers. They were a financial communications network. Each Rothschild brother was stationed in a different European capital, sending letters via private courier, often faster than official government channels. During the Napoleonic Wars, they financed both sides at different points, quietly moving money across borders while cannons roared in the distance. Legend has it that Nathan Rothschild knew about Napoleon's defeat at Waterloo before the British government did. That's how fast financial information travels when it really matters. And when you think about it, war is the ultimate stress test for any economy. It forces governments to invent new financial tools just to survive. That's where modern finance comes from. Not from peace, but from panic. National debt, for example, wasn't always normal. In medieval times, if a king needed money, he either taxed his people or borrowed from a few wealthy lenders, often reluctantly. But by the 18th century, Britain had perfected the art of public debt. They issued government bonds to fund wars against France, Spain, and just about anyone else who looked at them funny. Investors bought these bonds because they trusted the British government to pay them back, with interest, of course. And the more wars Britain fought, the more bonds they issued. Eventually, this debt system became a permanent feature of the economy. The London Stock Exchange wasn't founded because of stocks. It was founded because people wanted to trade government bonds, bonds that existed because of war. Banks didn't just facilitate this system, they thrived on it. War meant more borrowing. More borrowing meant more banking. It's a feedback loop with cannons in the middle. Even paper money owes part of its existence to war. In the 17th century, Sweden, of all places, pioneered banknotes during military conflicts because hauling around heavy coins was inconvenient when you were trying to fund armies. The idea spread quickly. Soon, governments realized they could issue paper backed by promises rather than gold. It was lighter to carry and, conveniently, easier to print. Wars also created the need for central banks. Before war finance, money was a local affair. Guilds, goldsmiths, private lenders. But when a nation needed to fund a massive army, it needed something bigger, a national institution. That's how the Bank of England came into being in 1694, not to manage the economy, but to help fund a war against France. The model stuck. Central banks became the quiet powerhouses of modern finance, managing debt, stabilizing currencies, and, in times of crisis, bailing out governments, all thanks to the problem of war. And then there's the insurance industry, another financial child of conflict. The first insurance markets in London weren't just about ships and cargo, they also insured military expeditions. If you funded a colonial army or a privateer ship, you could buy insurance to cover your losses if things went badly. Risk management wasn't invented in boardrooms. It was invented by people staring at maps of enemy coastlines, wondering if their investments would come back. You start to see the pattern. War doesn't just need money. It creates entirely new ways to think about it. Even in the modern world, financial systems expand during wartime. During World War II, the US government needed to fund an unprecedented military buildup, so it leaned heavily on Wall Street, issuing bonds, managing massive defense contracts, and coordinating with private banks to control inflation. It wasn't just a war effort. It was a financial experiment that rewired the global economy. After the war, the financial machinery stayed in place. The Federal Reserve took on a more active role. The World Bank and the International Monetary Fund were born out of post-war planning meetings. The global financial system you live in today, the one that handles currency exchange, international loans, and quiet overnight trades, has roots in war finance. Even the dollar as the world's reserve currency, that happened after World War II. Before that, gold and the British pound were the global standards. But by 1945, the US held most of the world's gold reserves. So the dollar quietly took center stage, backed by gold at first and then, eventually, by trust alone. Some economists argue that finance and war are permanently linked. Military spending drives technological innovation, which filters back into civilian markets. Defense contractors become conglomerates. Banks handle the transactions. And somewhere in the background, Government debt keeps piling up. And yet, for all the complexity, the basic system remains simple. Wars create problems. Finance invents solutions. Those solutions become permanent. It's not just about soldiers and generals. It's about ledgers and loans, about who funds the fight and who profits when the smoke clears. You begin to realize that war didn't just shape borders. It shaped balance sheets. It invented new forms of risk and new ways to manage it. In the next chapter, we'll look at what happens after the money changes hands, when land, property, and entire industries get reshuffled in the aftermath of war. Because war doesn't just move money, it moves ownership. You start to realize something about war. It's not just about who wins the battle, it's about who ends up holding the deed. Because when the dust settles, the real question isn't who fired the most shots, it's who owns what now. War has always been a machine for transferring property. Sometimes it's dramatic. Castles seized, palaces looted, entire nations carved up like a Sunday roast. Sometimes it's quiet, contracts rewritten, land deeds adjusted, corporations sold at a discount while no one's looking. But the pattern is always there. War changes ownership. Take ancient Rome. When Rome conquered new territories, they didn't just collect taxes, they took land. Huge estates called latifundia were handed over to Roman elites. Ordinary farmers found themselves pushed off their fields, replaced by slaves and aristocrats. It wasn't just military conquest, it was a real estate operation with swords. Fast forward to the Norman conquest of England in 1066. William the Conqueror didn't just win a battle at Hastings. He redistributed nearly all the land in England to his loyal knights and barons. Within a generation, the entire landowning class had changed. Anglo-Saxon nobles lost their estates. Norman lords gained them. The names on the castles changed, and so did the balance of power. You start to see a pattern. War resets the property ledger, and it's not just about land. Looting is a business model during conflict. In ancient times, it was expected. Gold, silver, livestock, even people were taken as spoils. But looting isn't always chaotic. Sometimes it's organized, systematic, and, let's be honest, profitable. During World War II, the Nazis looted art, gold, and cultural treasures across Europe. They stole not just from museums, but from private homes, banks, and safes. Swiss vaults filled up quietly. Paintings changed hands through secret auctions. And after the war, many of those items never found their way back. But looting isn't always about shiny things. Sometimes it's about leverage. When a war ends, treaties are signed. And in the fine print, you'll often find clauses about reparations, payments from the loser to the winner. These payments might involve gold, raw materials, industrial equipment, or even intellectual property. After World War I, Germany was forced to pay massive reparations to the Allied powers. Factories were dismantled, coal shipments were redirected. And when Germany couldn't pay, the French occupied the Ruhr Valley, a region rich in industry, to extract value directly. It's not subtle, but it works. And then there's the corporate side of war. During conflicts, companies change hands quietly. Assets get nationalized, factories are seized. Foreign businesses are rebranded or absorbed. After World War II, Japanese and German companies were often broken up or handed over to new owners as part of reconstruction deals. Sometimes the owners came back, sometimes they didn't. Even intellectual property gets caught in the shuffle. After WW2, Allied nations took German patents in fields like chemistry, engineering, and pharmaceuticals. Entire industries got a post-war head start by quietly absorbing knowledge from the defeated. There's also a softer, more modern version of this. Mergers and acquisitions during crises. When war destabilizes markets, companies go bankrupt. Assets sell at fire sale prices. The strong buy the weak. And by the time peace returns, entire sectors have been reshaped. Not by bullets, but by balance sheets. Take the Iraq War in the early 2000s. After the initial conflict, foreign companies flooded into Iraq to bid on contracts, buy oil rights, and secure construction deals. Some were rebuilding infrastructure. Others were quietly taking over parts of the economy once controlled by the state. Ownership doesn't always change hands at gunpoint. Sometimes it happens at board meetings. Even currency can change ownership. After wars, governments often devalue their own money or replace it entirely. The old currency becomes worthless paper. The new one is issued by whoever controls the printing press now. If you owned cash in the wrong denomination, your wealth vanishes overnight, transferred to someone else without a single shot fired. And for those who saw it coming, they converted their assets early into gold, foreign accounts, or portable wealth like art and jewelry. In war, liquidity isn't just an investment strategy, it's survival. You begin to understand why real estate, currency, and capital shift so dramatically during wartime. It's not always planned, but it's rarely accidental. Ownership after war is often a combination of luck, leverage, and being in the right or wrong place at the right time. Some historians call this process creative destruction. Old systems collapse, new ones rise, and along the way, property changes hands. The middle class usually shrinks. The very poor lose what little they had. And the very rich, well, they often diversify early, buy back assets at post-war discounts, and end up owning more than they started with. It's not fair, but it's common. War doesn't just redraw borders, it redraws bank accounts. And the people who understand that usually aren't found on the battlefield. They're found in offices, drafting contracts for the new world that's about to be built on the ruins of the old one. In the next chapter, we'll follow one of war's quieter winners, the people who understand inflation. Because when prices rise and money melts, someone always profits. You start to notice something about money during war. It behaves strangely. Prices go up. Currencies wobble. Bread costs more. Rent costs more. Wages. Well, they don't always keep up. If you're an ordinary person, wartime inflation feels like a punishment. But if you're wealthy, sometimes it feels like a coupon. That's one of the quieter secrets of war. Inflation doesn't hit everyone the same way. In fact, it can quietly shift wealth upward, from those who work for money to those who own assets. Let's start with the basics. Inflation means your money buys less than it used to. That's obvious when you're in line for groceries. It's less obvious when you're holding a diversified portfolio. In wartime, governments usually need to spend more on soldiers, weapons, logistics, rebuilding bridges someone just blew up. But wars are expensive, and raising taxes is unpopular. So governments print more money or borrow heavily, flooding the economy with cash. The result? Prices rise, and then they rise some more. Take World War I. European countries abandoned the gold standard so they could print money freely. Prices in Britain doubled between 1914 and 1920. In Germany, inflation was so extreme that by 1923, it took a wheelbarrow of marks to buy a loaf of bread. People literally burned cash to stay warm because fire was cheaper than food. But here's the thing. While ordinary people were watching their savings evaporate, the wealthy were moving assets. They weren't holding cash. They were holding hard assets, things like land, real estate, stocks, and gold. And those things tend to rise with inflation, or at least keep pace. In some cases, they outpace it. If you owned property during a war, your land still existed after the bombs fell, assuming you picked the right location. If you owned shares in companies that supplied the war effort, your dividends might actually increase. If you held gold or foreign currency, you were insulated from local collapse. Even debt becomes an opportunity. If you borrowed money before the war, inflation helps you pay it back later with cheaper currency. It's like taking out a mortgage and waking up to find that your monthly payment is now worth half as much, but the house is still yours. That's why, historically, the rich tend to come out of inflationary periods stronger. They don't rely on wages. They don't keep their wealth in cash. They diversify. They hedge. And they often have better access to financial advice, or just better instincts for panic. Meanwhile, the middle and lower classes watch their purchasing power dissolve. Salaries lag behind. Savings disappear. And fixed incomes, like pensions, become traps. During the French Revolution, the government printed so many assignats, paper money backed by confiscated church lands, that the currency collapsed. Merchants refused to accept it. Prices soared. The rich converted their assets early. The poor paid the price at the bakery. This isn't just a European story. During the American Civil War, the Confederacy printed money to fund its war effort. By 1865, Confederate dollars were so worthless that soldiers used them to line their uniforms. But wealthy Southern families often moved their assets into gold or foreign banks before things got that bad. Some even bought property in the North, hedging their bets. And in more recent history, the pattern holds. During World War II, rationing and price controls slowed inflation on paper, but black markets thrived. People with connections, usually the well-off, got access to scarce goods at inflated prices, then sold them quietly for profit. It wasn't just about money, it was about who had access. You begin to understand that inflation isn't just a financial phenomenon, it's a social sorting mechanism. Those who know how to protect themselves do. Those who don't, can't. It's also about timing. The rich tend to get information first. They hear about currency devaluations before the general public. They move money offshore. They buy hard assets. They stockpile resources. By the time the rest of the population feels the pinch, the upper class has already adjusted. This creates what economists call a wealth gap amplifier. Inflation makes the rich richer, not because they hoard cash, but because they hoard options. They have room to maneuver. Everyone else is stuck at the checkout counter, wondering why butter costs more this week than last. Even central banks know this. During wartime, they often tolerate inflation quietly because it makes government debt easier to manage. Inflation shrinks the real value of what the government owes. It's not a conspiracy, it's just math. But the side effect is that ordinary people lose out. And when the war ends, the price hikes rarely go back to normal. Wages stay low, goods stay expensive, and the economy resets itself with a new, wider gap between the top and the bottom. It's not that the rich are evil masterminds in this scenario, although some certainly try. It's that the financial system is designed to reward asset holders in times of crisis. If you own stocks, real estate, gold, or collectibles, you're positioned to survive inflation. If you rely on a paycheck, not so much. This isn't about fairness, it's about structure. War creates scarcity. Scarcity raises prices. And those with the right assets, or the right timing, end up wealthier when it's over. It's one of the quieter outcomes of conflict. No parades, no headlines, just silent wealth accumulation while the rest of society scrambles to catch up. In the next chapter, we'll look at what happens when scarcity becomes strategy, when black markets and shadow economies take over, and war creates an entirely new kind of wealth underground. Because in times of shortage, someone always finds a way to sell. You start to realize something about wartime economies. Officially, everything is accounted for. There are rations, price controls, government contracts, ledgers full of patriotic math. But just beneath the surface, there's another economy, quieter, faster, often more profitable. It's the shadow economy, and in wartime, it thrives. Because war creates scarcity, and scarcity creates opportunity. Governments, in an effort to control chaos, usually impose rationing. It's supposed to be fair. Everyone gets a little of what they need. Butter, sugar, gasoline, fabric. You might even get a booklet with coupons printed in neat columns, as if the crisis could be solved by stationery. But rationing has side effects. People still want more than they're allowed. Factories still need materials. Armies still demand supplies. And somewhere in the cracks, markets form to fill the gaps. These aren't always sinister operations. Sometimes they're just neighbors trading quietly. Soap for bread, fuel for medicine. But over time, the informal trade becomes organized. Smuggling starts, prices rise, networks form. And before you know it, the black market is the real market. Take World War II. In London, people queued for hours to get their government-allocated slice of meat. Meanwhile, if you knew the right butcher, you could slip behind a curtain and buy sausages. No questions asked, but for a price. In France, black market cheese and wine circulated like secret handshakes. In Germany, farmers traded food directly for goods, bypassing official channels entirely. In war zones, cash often becomes less important than barter. cigarettes, chocolate, nylon stockings, these become currency. In post-war Berlin, after 1945, American cigarettes were more stable than the German mark. You could buy dinner, furniture, even surgery, if you had the right pack of smokes. This isn't new. In ancient times, armies on campaign created their own shadow economies. Camp followers sold food, armor repairs, and other services not listed in the official military budget. Some things never make it onto the scrolls. Even governments participate, unofficially. During Prohibition in the 1920s, the US wasn't at war, but the logic was the same. Ban alcohol? A black market will provide it. Moonshine, speakeasies, entire underground supply chains. The same mechanics happen in wartime, only now it's food, fuel, medicine, and where there's demand, there's always someone willing to supply. Black markets don't just exist, they thrive, they become efficient, organized. Sometimes they grow so large that the official economy can't function without them. During the Vietnam War, American soldiers stationed overseas participated in unofficial trade networks. Supplies fell off trucks, were sold locally, and circulated back into the market. Everything from military rations to uniforms found second lives in civilian hands. You start to realize that shadow economies aren't just about criminality, they're about necessity. When official channels fail or become too rigid, people invent new systems. But there's a cost. Black markets usually favor those with connections. If you know the right people, you can get scarce goods. If you don't, you wait in line, or you go without. Prices rise not because of greed, but because risk has a price. Smuggling flour past a military checkpoint is dangerous. The markup reflects that. Scarcity creates middlemen. Middlemen create profit. And sometimes the shadow economy becomes permanent. In Soviet Russia, shortages were part of daily life for decades. An entire class of people called blat specialists emerged. Those who knew how to pull strings, make trades, and get what wasn't officially available. It wasn't considered crime. It was considered survival. The same happens during wars. Black markets blur into grey ones. Soldiers trade supplies. Civilians learn to barter. Even officials participate quietly, knowing that the system on paper isn't the system in practice. There's even a name for this in economics, the informal economy. It's not taxed, not regulated, but it's very real. And in times of war, it's often the only thing keeping people fed. Of course, the rich have advantages here too. They know how to get what they need through connections, offshore suppliers, or sheer purchasing power. The poor, they're usually stuck in the official economy, waiting for rations. In some cases, entire fortunes are made this way. During the Iraq sanctions of the 1990s, a program called Oil for Food was supposed to prevent black markets. But loopholes emerged. Smuggling networks thrived. Billions of dollars flowed through unofficial channels. By the time anyone noticed, it was too late. The shadow system had replaced the official one. Even in modern conflicts, the pattern continues. Wherever there's war, there's a secondary economy. Think of it as a parallel universe with its own rules. You start to understand that scarcity isn't just a hardship, it's a business model. Black markets aren't mistakes. They're the natural byproduct of control. And when peace comes, these shadow systems don't always disappear. Sometimes they stay. Sometimes they evolve. Sometimes they become the new normal. In the next chapter, we'll look at what happens after the war, when the rubble is cleared and the rebuilding begins. Because reconstruction is big business. And sometimes, the profits made after the war are even larger than the ones made during it. You start to realize something subtle about wars. The destruction is loud, but the reconstruction? That's where the real money is made. Because when the smoke clears and the ruins settle, the world needs to rebuild. Cities, industries, supply chains, all of it has to be stitched back together. And that process isn't just humanitarian, it's economic. Post-war rebuilding is one of history's most reliable wealth engines. For every bombed-out building, there's a contract to rebuild it. For every collapsed currency, there's a financier ready to restructure the debt. And for every crater in the ground, there's a blueprint in someone's briefcase. Take Europe after World War II. The continent was in ruins. Bridges gone, factories flattened, food supplies disrupted. But almost immediately, the gears of reconstruction started turning. Enter the Marshall Plan, a massive US financial aid program designed to help Europe rebuild. On paper, it was about recovery. In practice, it was also about influence. The US poured billions of dollars into Europe, not just to prevent famine, but to stabilize capitalism and create future trading partners. That money didn't float in the air. It went to construction companies, engineering firms, and suppliers. Cement was shipped, steel was forged, railways were rebuilt, and quietly, contracts were signed. Lots of them. Some historians argue that the real beneficiaries of the Marshall Plan weren't just European citizens. They were American corporations that got first dibs on rebuilding contracts, equipment sales, and new market opportunities. But this isn't just about governments. Private companies thrive in post-war economies. In fact, many modern corporate empires started during periods of reconstruction. Take Japan after World War II. The country was devastated, but within a few decades, it became an economic powerhouse. How? By rebuilding industries from scratch, sometimes with American guidance, sometimes with local innovation. Companies like Toyota, Sony, and Honda rose from the ashes, reshaping global trade along the way. You start to realize that war resets the playing field. Old monopolies collapse, new ones emerge, land gets redistributed, businesses change hands. In the chaos, new fortunes are built by the people who see opportunity in disaster. Reconstruction also creates jobs. Infrastructure needs workers, cities need planners. But the profits? Those usually go to the contractors, financiers, and suppliers at the top of the chain. Sometimes the rebuilding process is more lucrative than the war itself. After the US invasion of Iraq in 2003, billions of dollars were allocated for reconstruction. Roads, hospitals, power plants, all needed to be rebuilt. But much of that money ended up in the hands of foreign contractors, private security firms, and multinational corporations. Some projects were completed. Others vanished into paperwork and offshore accounts. War tears things down. Contracts build them back up with a markup. There's even a quiet financial term for this: disaster capitalism. The idea that crises, whether natural disasters or wars, create opportunities for profit. It's not always nefarious. Sometimes it's just business. But the timing is everything. Those who step in early, while the debris is still warm, usually set the terms. Post-war reconstruction also involves debt restructuring. Countries borrow heavily to rebuild. International banks step in. Loan agreements are drafted. And over time, these debts become part of the global financial system. This creates a strange loop. The same financial institutions that profited from wartime loans often profit again from post-war reconstruction loans. It's like refinancing a house after the hurricane, only the house is a country. And then there's real estate. Bombed cities get rebuilt. Sometimes they're reconstructed exactly as before. Other times they're redesigned entirely. New neighborhoods, new zoning laws, new ownership. Look at Berlin after World War II. The city was carved up by Allied powers, then rebuilt in stages. Property changed hands, sometimes legally, sometimes not. After the Cold War ended, reunified Berlin became one of Europe's real estate booms. Today, you can stand in a modern apartment and know that 70 years ago, that same plot of land was rubble. You start to see the pattern. Post-war economies are gold rushes wearing hard hats. The process is complicated. It involves diplomacy, loans, logistics, and construction. But at its core, it's still about supply and demand. The demand, everything is broken. The supply, money, materials, labor, and, most importantly, access. Those with the right political connections often get the biggest contracts. Reconstruction tends to be less about free markets and more about relationships. Who you know can matter more than what you build. Sometimes it works beautifully. Countries recover, economies thrive, people rebuild their lives. But sometimes the profits stay concentrated at the top, while ordinary citizens wait for services that never arrive. Even decades after the guns go silent, the echoes of post-war deals can still be heard in boardrooms and stock portfolios. Because when you rebuild the world, you get to decide who owns it next. In the next chapter, We'll follow the quiet winners of war, the neutral countries, the ones who stayed out of the fight but still collected the fees. Banking, storage, shipping, diplomacy. There's big money in not picking a side. You start to notice something about wars. While nations clash and empires crumble, there's always someone watching quietly from the sidelines, counting the ships, balancing the ledgers, polishing the silver in neutral ports. Because in every war, there's a third party, the bystander who profits. Staying neutral in a conflict doesn't mean staying uninvolved. It often means becoming the middleman, the safe harbor, the trusted vault, and sometimes the place where fortunes quietly change hands. Take Switzerland. The world's most famous neutral nation has mastered the art of profitable inaction. During both world wars, Switzerland officially stayed out of the fighting. But behind closed doors, Swiss banks accepted deposits from every side. German gold flowed into Swiss vaults, much of it looted from occupied territories. Allied nations also used Swiss financial services because neutrality makes for excellent discretion. It wasn't just about gold. Switzerland's watch industry kept ticking, supplying precision instruments for both military and civilian use. Factories stayed open. Accounts stayed private. And when the war ended, Swiss neutrality meant no reparations, no bombed cities, and a financial system that was mysteriously larger than before. But Switzerland wasn't alone. In the Napoleonic Wars, the tiny principality of Liechtenstein quietly facilitated banking deals while neighboring nations burned. The Dutch Republic, before being swallowed by the French, once made fortunes by trading with both sides during 17th century European conflicts. Ships changed flags mid-voyage, ports shifted loyalties with the tide, and merchants whispered their way through embargoes. Even Sweden, during World War II, maintained a careful neutrality while exporting iron ore to Nazi Germany and trading with the Allies. It wasn't about politics, it was about keeping the economy humming. Neutrality, it turns out, is often less about morality and more about risk management. When countries go to war, trade routes close, currencies collapse, and financial systems seize up. But neutral nations become the workaround. Need to store gold? Ship it to Zurich. Need to move cash? Open an account in Geneva. Need to meet with the enemy secretly? Book a hotel conference room in Bern. There's a reason peace talks usually happen in neutral cities. It's not just about diplomacy, it's about location services. These nations often provide the infrastructure of war without firing a shot. Safe shipping lanes, banking networks, storage facilities, legal arbitration. They grease the wheels while everyone else throws punches. Sometimes the role is unofficial. Sometimes it's a national strategy. Panama, for example, became a financial hub, partly because of its neutral position in various global conflicts. Its canals stayed open. Its banks stayed friendly. And over time, it built an economy based on facilitating trade, no matter who was trading. Even Portugal during World War II played this game. Officially neutral, Lisbon became a hotbed of espionage, smuggling, and financial maneuvering. Refugees passed through. Gold changed hands. Intelligence agents from both sides sipped coffee at the same cafes. You start to realize that neutrality doesn't mean absence. It often means quiet participation. In modern times, this tradition continues. Tax havens and offshore banking centers thrive during global crises. When sanctions hit one nation, another offers a loophole. When assets are frozen in one country, they thaw in another. Shell companies, blind trusts, discrete transactions. They don't stop for conflict. In fact, conflict often increases demand. There's even a phrase for this in finance: flight to safety. When the world feels unstable, money looks for calm places to hide. Neutral countries offer that calm for a fee. And while the world debates the ethics of war, someone is always managing the spreadsheets. This isn't necessarily evil. In some cases, neutral nations provide critical services, banking, shipping, communication, that keep humanitarian efforts going. Red Cross accounts need banks too. Refugees need safe passage. Not every transaction is blood money. But the line between neutral support and opportunistic profit can get blurry. And when the war is over, The bystanders often come out ahead. Their cities are intact. Their financial sectors are larger. Their industries are poised to capitalize on the reconstruction contracts. They didn't win the war, but they didn't lose it either. They just waited, provided services, cashed the checks. You start to see the pattern. In every conflict, someone stays in the background, counting the profits, while others count the casualties. In the next chapter, we'll look at one of the most patriotic financial tools ever invented, the war bond. Because when governments need money fast, they don't just tax the rich. They ask ordinary citizens to lend them their savings. And sometimes, the return on that investment is more symbolic than financial. You start to notice something about war finance. When governments need money fast, they don't always go straight to the bankers or the big corporations. Sometimes they go to you, or at least to the citizen standing in line at the bakery, wondering why sugar is rationed again this week. That's where war bonds come in, the most patriotic IOU in history. At first glance, a war bond is just a piece of paper. You buy it from the government, you lend them money, they promise to pay you back later with a little bit of interest. But during a war, bonds become something bigger. They become propaganda. Posters appear on walls. Radios crackle with messages. Children are told to save their allowances and buy small bonds called victory stamps. The slogans are everywhere. Lend your money to your country. Buy bonds to back the boys. Save freedom, buy a bond. It sounds noble. And in many ways, it is. Bonds fund armies, build ships, supply medical kits. But they also shift the burden of war financing from governments onto ordinary people. Let's go back to World War I. In the US, war bonds were called Liberty bonds. They were sold in town squares, at movie theaters, even door to door by volunteers. Celebrities pitched them. Parades were organized around them. People who didn't buy bonds were sometimes shamed publicly. If you weren't investing, were you really patriotic? The same happened in World War II with victory bonds. More than 85 million Americans bought them. In Britain, war savings certificates played a similar role. Governments framed it as a moral duty, not just supporting the troops, but investing in the nation's survival. But here's the quiet part nobody likes to say out loud. War bonds aren't always a great investment. The interest rates are usually low, the terms are long. And in times of inflation, especially wartime inflation, the real value of what you get back is often less than what you put in. If you bought a $100 bond in 1942 and redeemed it 10 years later, the nominal amount might be higher. But after inflation, your money bought fewer groceries. The wealthy knew this. That's why they often invested in different assets, real estate, commodities, stocks in defense companies. Bonds were more of a public gesture. For the middle and working class, though, bonds were a savings tool. A piggy bank with a flag on it. Many people cashed them in years later to buy houses, send kids to college, or start small businesses. Sometimes the returns were modest. Sometimes the act of saving was the real reward. There's even a psychological trick at play. Bonds don't feel like a tax, even though they serve a similar function. They're voluntary. You choose to buy one. It's framed as empowerment, not obligation. But in practice, war bonds shift the financial burden of conflict onto citizens, while preserving wealth for those who can afford to invest elsewhere. During the Napoleonic Wars, Britain issued government bonds to fund military campaigns. Wealthy investors bought them, creating a permanent national debt. Over time, those bondholders became part of the British elite, earning steady interest from taxes paid by ordinary citizens. In modern times, governments have refined the pitch. Bonds come with sleek marketing, emotional appeals, and patriotic branding. But the structure remains the same. You lend, they spend, you wait, and sometimes you get back less than you hoped for. Not because the government defaults, but because the economy shifts under your feet. After World War II, many countries paid off war bonds with money that had been devalued by inflation. People still got their checks, but what those checks could buy had changed. You start to realize that war bonds aren't just about finance, they're about social cohesion. They tie citizens to the war effort, creating a sense of participation. Even if you're not on the battlefield, you're doing your part. There's nothing inherently wrong with that. Collective action has value, but the financial mechanics are worth noticing. In essence, governments borrow from their own people during wartime, then repay them slowly, using future tax revenues, often the same people's taxes. It's like lending money to your roommate so they can buy groceries, only to have them use your shared rent money to pay you back later. Technically, it works. But the money circles the same drain. Even today, countries issue savings bonds during crises. The mechanics are softer now: digital bonds, online platforms, retirement accounts. But the idea remains. When governments need funds, they often ask the public to become lenders. It's not just about raising money. It's about controlling inflation, absorbing excess cash, and creating a sense of unity. But in the end, the financial winners are usually those who diversify, the ones who buy some bonds, yes, but also invest in assets that grow faster than wartime economies shrink. Because while citizens are buying bonds, the well-connected are often buying stock in the companies that make the tanks. In the next chapter, we'll follow the rich as they flee, because sometimes the smartest financial move in wartime isn't to invest locally. It's to take your assets and run. You start to notice something about wars. Not everyone stays to fight. Some people flee, and when they do, they don't always leave empty-handed. Because there's a special category of refugee, the kind who packs not just a suitcase, but a fortune. Elite flight capital is one of history's quieter patterns. When conflict starts, the wealthy often move their money first, then their families, then, if necessary, themselves. It's not cowardice, it's strategy. Take the Russian Revolution of 1917. When the Bolsheviks seized power, Russian aristocrats fled in droves. But they didn't just grab heirloom teacups. They took diamonds, gold, and portable assets. Some hid jewels in clothing hems. Others wired money to Parisian banks weeks before the revolution fully erupted. By the time Lenin took the Winter Palace, much of Russia's elite wealth had already escaped. Fast forward to World War II. Wealthy Jewish families across Europe tried to convert property into liquid assets before the Nazis arrived. Some succeeded, stashing art, gold, and securities in Swiss banks. Others weren't so lucky, trapped by border closures, currency controls, and anti-Semitic laws that froze accounts. Those who moved early often survived financially. Those who waited didn't. This isn't just a 20th century story. During the fall of the Roman Empire, aristocrats in the western provinces sent gold east to Constantinople, where the Eastern Roman Empire, what we now call Byzantium, still held power. They knew the barbarians were coming, so they shipped their wealth somewhere safer. In modern terms, this is called capital flight, and it happens fast. When a war seems imminent, the wealthy don't wait for the first cannon blast. They read the signs, the currency fluctuations, the political speeches, the jittery markets. They convert cash into gold, buy property abroad, move funds offshore. Sometimes they get criticized for it. Leaving your country with a briefcase full of bearer bonds isn't exactly patriotic, but from a financial perspective, it's rational. After all, war rarely destroys wealth. It just redistributes it. The trick is to make sure you're not on the losing end of that redistribution. This is why offshore banking exists. Switzerland, the Cayman Islands, Luxembourg, these places aren't just for tax avoidance, they're for crisis insurance. If your home country collapses, your foreign account might still be safe. Some families treat this like generational wisdom. Keep part of your wealth in a stable currency. Own property in multiple countries. Make sure at least one bank account is in a neutral nation. It's not glamorous, but it works. Even during recent conflicts, the pattern continues. When Venezuela's economy collapsed, elites moved money to Miami condos, offshore accounts, and cryptocurrencies. When Ukraine was invaded, many wealthy Ukrainians had already diversified into London real estate and EU-based businesses. It's not always legal, and it's rarely fair, but it's predictable. Wealth is portable in ways that people aren't. You can move gold faster than you can move a family. You can wire money in seconds, while visas take months. And sometimes, the rich don't even have to leave physically. They just move their assets first, creating a financial escape route long before they book a flight. There's also a quieter reason for this behavior. Wars change ownership laws. If you wait too long, your assets might be frozen, nationalized, or seized. Revolutionary governments are particularly good at this. So are invading armies. That's why early movers often survive. They see war not just as violence, but as a liquidity event. But not all wealth is so easy to pack. Factories can't be moved. Land can't be relocated. Businesses tied to local economies usually stay put, and sometimes collapse. That's why financial assets, art, jewelry, and gold become the currency of survival. They fit in bags. Some refugee families emerge from war poorer in social standing but still wealthy in financial terms. They set up new lives abroad, fund new businesses, or quietly join the upper class in new countries. Others lose everything, not because they were poor to begin with, but because they moved too late. You start to understand that fleeing isn't just about safety. It's about asset preservation. In financial circles, there's even a phrase for this: wealth on the run. It's not romantic, but it's real. In the next chapter, we'll look at what happens after the dust settles, when the corporations that survived the war consolidate power, swallow their competition, and quietly take over entire industries. Because sometimes the winners of a war aren't generals, they're CEOs. You start to notice something about wars. They don't just change governments, they change who owns everything. Because after the battles end, there's a quieter game that begins, a corporate chess match, where companies merge, absorb, and outlast the competition. And usually, the biggest players win. Wars are excellent at shrinking markets. Bombed factories don't produce goods. Supply chains collapse. Competitors go bankrupt. And when the economy resets, the survivors don't just pick up where they left off, they consolidate. It's not always about greed. Sometimes it's about efficiency. After a war, governments need industries to rebuild quickly. Fewer companies means faster coordination. But fewer companies also means more power concentrated at the top. Take World War I. Before the war, dozens of small arms manufacturers existed in Europe. After the war, many were bankrupt, bought out, or merged into larger conglomerates. The arms industry streamlined itself, not just for profit, but because governments wanted national champions, companies big enough to handle massive military contracts. Then came World War II, and the pattern repeated. In the United States, small defense contractors were swallowed by larger firms. By the 1950s, a few companies controlled most of the defense industry. That's how the military-industrial complex was born, not from peacetime greed, but from wartime necessity that never fully went away. Look at Boeing, Lockheed Martin, Raytheon. These aren't just brands. They're the result of decades of wartime mergers, acquisitions, and government-backed expansion. They outlasted their competitors because they were big enough to survive, and big enough to win contracts no one else could handle. But it's not just about weapons. During wars, industries of all kinds reshape. Textile companies pivot to make uniforms. Car manufacturers build tanks. Pharmaceutical companies develop battlefield medicines, then sell them commercially after the war ends. And when peacetime returns, many of these industries don't go back to their old ways. They keep growing, keep consolidating, and quietly take over larger shares of the economy. Take Kodak during World War II. It made cameras in peacetime, but during the war, it produced military optics. After the war, it expanded rapidly because the systems it built for wartime production didn't disappear. They pivoted to consumer markets, but the infrastructure remained. Even Coca-Cola benefited from wartime logistics. The US government classified Coke as an essential morale supply during World War II, helping the company build bottling plants worldwide for the troops. After the war, those plants stayed open. By the 1950s, Coca-Cola wasn't just a soda company, it was a global brand. You start to realize that war isn't just about destruction. It's about industrial survival of the fittest. Weak companies fold, strong companies grow stronger, and the survivors rewrite the rules. Sometimes this process is direct. Governments take control of failing industries, merge them into national corporations, then privatize them later, usually to the benefit of a few well-connected investors. After World War II, British steel was nationalized to stabilize the post-war economy. Later, it was privatized in the 1980s, creating one of the largest steel companies in Europe. The same happened with energy, transportation, and telecommunications in various countries. Other times, the consolidation is quieter. Companies buy up their weakened rivals, acquire patents, absorb customer bases, and quietly increase their market share. Think of Sony after the war in Japan. It started small, making radios with leftover military parts. But as Japan rebuilt, Sony grew into a global electronics powerhouse, partly because so many competitors didn't survive the post-war restructuring. Even in finance, war reshapes ownership. Banks collapse under stress. Survivors merge. New financial systems emerge. After the 2008 crisis, a kind of economic war in its own right, banks like JP Chase and Bank of America swallowed weaker institutions, becoming even larger. This pattern isn't accidental, it's structural. Crises shrink the field, survivors expand to fill the vacuum, and once a company becomes big enough to dominate an industry, it often stays that way because scale breeds stability. Governments prefer dealing with a few large suppliers rather than dozens of small ones. Contracts get streamlined, regulations get lobbied, the system adjusts to favor the giants. Sometimes this leads to monopolies. Other times it leads to oligopolies, a handful of companies controlling everything, quietly coordinating without needing to meet in secret rooms. The end result is the same: fewer players, bigger profits. You start to see why corporations don't fear wars the way individuals do. For the right kind of company, war is both a risk and an opportunity. If they survive, they often emerge larger, more entrenched, and harder to compete with. It's not just about winning the war, it's about owning the economy that comes after. In the next chapter, we'll look at what happens when peace treaties aren't about peace. They're about debt. Because sometimes the terms of surrender don't involve swords, they involve spreadsheets. You start to realize something about peace treaties. They're not just about stopping wars. They're about starting debts. When the cannons fall silent, the negotiations begin. Borders are redrawn, governments change hands. But underneath the politics, there's always the money. Someone has to pay for the damage, and that's where reparations come in. At first glance, reparations sound simple. One side loses the war, so they pay the winners to rebuild. But in practice, it's never that tidy. Reparations aren't just about fairness. They're about leverage, punishment, and sometimes profit. Take the Treaty of Versailles, signed in 1919 after World War I. Germany was held responsible for the war and ordered to pay massive reparations to the Allied powers. The bill was enormous, over 132 billion gold marks, which in today's money would equal hundreds of billions of dollars. Germany couldn't pay it, so they printed money instead, and you already know how that turned out. The hyperinflation of the Weimar Republic, the wheelbarrows full of banknotes, the stories of housewives wallpapering homes with worthless cash, was partly the result of those reparations. And while ordinary Germans watched their savings evaporate, international creditors and currency speculators quietly found ways to profit from the chaos. But this wasn't the first time peace came with a price tag. After the Franco-Prussian War of 1870, France paid huge reparations to Germany. The French government borrowed billions to cover the cost, sparking a massive financial boom in Berlin. German bankers and industrialists didn't just win the war, they collected the interest afterward. Even the ancient world played this game. When Rome defeated Carthage in the Punic Wars, they didn't just take land, they demanded regular payments of silver. Carthage paid for years, until Rome decided they wanted the city gone anyway, and burned it to the ground. So much for being paid back. You start to understand that war debts and reparations are part of the business model of conflict. They create winners and losers long after the last battle. But reparations aren't the only form of post-war finance. There's also reconstruction loans. After World War II, instead of punishing Germany again, the Allies shifted strategies. The Marshall Plan provided aid to rebuild Europe, not as reparations, but as a way to stabilize markets and prevent another collapse. But this aid came with strings attached: influence, access to markets, and long-term geopolitical control. In some ways, debt replaced direct punishment, and in other cases, war leaves countries so financially broken that they simply default. Defaulting on war debt isn't unusual. In fact, it's almost expected. After World War I, many European nations borrowed heavily from the US to finance the war. When the war ended, they struggled to repay. The Great Depression made it worse. By the 1930s, most countries had either stopped paying or restructured their debts entirely. This creates a cycle. Nations borrow to fund wars. They lose or win, but either way the debt remains. After the war, they restructure that debt, sometimes by negotiation, sometimes by sheer necessity. Bondholders take haircuts. Banks adjust their balance sheets. Economies wobble into the next crisis. It's not just national governments that play this game. Corporations do it too. After wars, companies with wartime contracts often shift their invoices to post-war governments. They demand payment for services rendered, sometimes at inflated rates. Legal disputes ensue, settlements are reached, but the money always moves somewhere. And then there's the quiet layer of asset seizures. During wars, countries often freeze or confiscate enemy assets. After wars, they decide what to do with them. Sometimes they return them, sometimes they don't. After World War II, Allied governments seized German and Japanese assets abroad. Factories, shipping fleets, bank accounts. Some were sold off to pay reparations. Others quietly changed ownership. Even in recent conflicts, this pattern continues. Sanctions and asset freezes are modern versions of post-war economic control. They don't require armies, just accountants. You start to see why economists pay more attention to treaties than to troop movements. Wars might be won on battlefields, but the aftermath is negotiated in spreadsheets. And the balance of power often depends less on who has the most weapons and more on who controls the debts, the reparations, and the financial systems left standing. In the next chapter, we'll look at something more subtle, but just as powerful: how the wealthy shape the way wars are remembered. Because history isn't always written by the victors. Sometimes it's written by the people who can afford to sponsor the museums. You start to realize something about wars. They don't just change borders, they change stories. Because after the treaties are signed and the monuments go up, there's a quieter battle that begins. The fight over memory. And unsurprisingly, it often comes down to money. History isn't just written by the victors. It's written by the people who can afford to sponsor the version that gets remembered. Take the statues, the textbooks, the national holidays. Someone funds those. Someone commissions the plaques, the museums, the documentaries. And over time, the messy complexity of war gets distilled into something simpler, easier to digest, easier to control. This isn't always propaganda in the obvious sense. Sometimes it's just branding. Consider the American Civil War. After the South lost, the wealthy Southern elite sponsored what became known as the Lost Cause narrative, a romanticized version of events that framed the Confederacy as noble defenders of tradition, rather than slaveholders trying to preserve an economic system. This wasn't just about pride. It was about controlling the narrative to protect post-war social hierarchies. Statues went up, textbooks were edited. Generations grew up believing a version of history curated by those with the deepest pockets. The same thing happened after World War I. In Britain, wealthy families funded memorials that honored fallen soldiers, but avoided awkward discussions about war profiteering or class divisions. The focus was on sacrifice, not on the stock prices of munitions companies. You start to see a pattern. The people who profit from war often invest in the way war is remembered. It's not about rewriting facts. It's about choosing which facts to highlight and which ones to quietly leave in the archives. After World War II, corporate sponsors helped shape post-war culture. Defense companies funded museums, veterans' charities, and historical documentaries. The narrative emphasized heroism and unity, not procurement scandals or the industrial profits made along the way. Even the Marshall Plan, while genuinely helpful to Europe, became part of a larger Cold War myth, funded and promoted as evidence of American generosity, rather than as a strategic move to prevent the spread of communism and secure new markets. In modern times, the pattern continues. Foundations, trusts, and corporate donors sponsor history projects, sometimes with subtle guidelines about tone and focus. It's not always sinister. Sometimes it's just soft influence. But it's influence nonetheless. There's even a term for this in academic circles: memory management. It's why you'll find gleaming war museums that focus on bravery and sacrifice. but not always on the contracts signed in the background. It's why corporate-funded documentaries highlight battles, but rarely boardrooms. And it's not just about the past. It's about the future of profits. Controlling the narrative means controlling how societies understand conflict, who gets blamed, who gets praised, and, most importantly, who gets trusted the next time a war rolls around. Because if the public believes that wars are about honor, defense, and necessity, they're more likely to support the next one. If the public remembers that wars are also about contracts, patents, property, and profit margins, things get more complicated. This is why memory is curated. Museums often depend on wealthy donors. Public history projects rely on grants. Textbooks are quietly influenced by committees funded by foundations. And memorials. Someone pays for the stone. You start to realize that history isn't just what happened. It's what gets repeated. And repetition takes funding. This doesn't mean all history is fake. But it does mean that some versions get louder megaphones than others. It's why statues of generals go up faster than statues of accountants, even though, as you now know, the accountants were just as involved. In the next chapter, the final chapter, we'll take a step back and look at the larger cycle. Because after all this talk of wealth, war, and memory, there's one more truth to face. The next war is always for profit too. By now, you've probably noticed something about the history of war. It's not just about politics, or land, or ideology. It's about money. And not just the money spent. The trillions in defense budgets, the stockpiles of weapons, the debts left behind. It's about the money made. Because every time a war ends, the system resets itself for the next one. And the cycle begins again. It's not always intentional. Politicians don't gather in secret and decide, let's have another conflict because the defense stocks are down. But the incentives are there, and incentives shape history. Consider the defense industry, sometimes called the military-industrial complex. Though the phrase is so familiar now, it barely raises an eyebrow. Companies that make weapons don't close their doors after a war. They lobby for contracts. They innovate. They look for new markets. And governments, with standing armies and standing budgets, often oblige. After World War II, the US didn't demobilize the way previous empires did. Instead, it kept the machinery of defense running at full speed. Because in the Cold War, peace was rebranded as preparedness. The same factories that made tanks switched to making jet engines. The same scientists who built wartime technology went on to invent the modern surveillance state. The money kept flowing. And the idea of a peacetime economy quietly faded into history. But it's not just about military production. War, and the fear of war, creates entire industries of anticipation. Cybersecurity, private military contractors, defense consulting, infrastructure hardening, emergency procurement. Even speculative markets get involved. Investors hedge against conflict. Commodity prices spike at the first rumor of war. Traders bet on sanctions, shortages, and disruptions. It's not always sinister. Sometimes it's just risk management. But the system learns to profit from instability. And that creates a subtle loop. The more profitable war becomes, the more likely it is to keep happening. Not because anyone wants chaos, but because the machinery prefers motion. There's also the political layer. War distracts from domestic problems. It unites populations around common enemies. It justifies budgets, creates jobs, and simplifies elections. No candidate ever lost votes by promising to keep the nation safe, even if that promise involves massive defense spending. You start to realize that war isn't always about the war itself. It's about the industries and systems built around it. And those systems don't go away when the fighting stops. They adapt. They wait. They lobby for the next reason to stay relevant. Some historians call this the permanent war economy. Others just call it reality. And it's not new. In ancient Rome, military expansion kept the empire financially afloat for centuries. Conquer new territory, extract wealth, pay the army, repeat. When the conquest slowed, the empire struggled. War was baked into the budget. In the colonial era, imperial powers justified endless expansion as bringing civilization to new lands. But underneath the rhetoric was a simple economic motive. More resources, more markets, more wealth. Today, the same logic plays out in different ways. Nations intervene abroad for security reasons. Yes, but also for access to oil, trade routes, rare minerals, and political leverage. It's not always about bullets and bombs. Sometimes it's about tariffs, sanctions, and supply chains. But the mechanics are the same. Conflict creates profit. Profit funds more conflict. And the cycle keeps spinning. You might wonder, is this inevitable? Maybe not. But history suggests it's hard to stop. Because war isn't just about fighting, it's about economics. And economic systems tend to follow the path of least resistance, especially when that path is paved with contracts, debt, and infrastructure that needs to stay in use. So you drift back from this journey through war and wealth with a new lens. You realize that when wars happen, it's not just about armies, it's about markets, about shifting ownership, about who supplies the uniforms and who rebuilds the cities after they burn. And when the next conflict comes, whether it's fought with drones, data, or something no one's invented yet, the pattern will probably look familiar. Because at the end of the day, the machinery of war runs on profit as much as politics. And history? History is just the invoice.